This video covers the end of Chapter 10, which is titled Hedging with T-bond futures, stock index futures, speculation, and spreads. At least that's the way I title it. As usual, skip the foreign currency. That's what FX stands for, contracts. Skip or skim the discussion on CTD, cheapest to deliver, and Treasury bond delivery options. The textbook goes deep into that to the point where you can get lost in just trying to figure out what it means by cheapest to deliver and what delivery options have to do with things. I'll explain it to you briefly. Cheapest to deliver means that when you are long a Treasury bond contract, futures contract, that means in the future you're going to give up money and you're going to take possession of a bond. Well, which bond? That's the question. If you, in the contract, write a very specific bond as being delivered, the problem is that bond could be subject to a squeeze play or just be in short supply, meaning it won't be available for delivery, and then next thing you know, you have a problem, a bottleneck in the futures market, and that's not what the futures exchanges want to have, and traders want to have in general. So what they allow is, for the delivery, is not a specific bond with an exact maturity and exact coupon, and we're talking, by the way, Treasury bond futures. They allow for a variety of different bonds to be delivered. And the reason for that, again, is to prevent bottlenecks. And so you're going to say, well, wait a second now. If you can deliver one of maybe 20 different bonds for a contract, then somebody's going to get cheated and somebody's going to make out big time. Like, for example, the person who has the short position is going to look around and find the cheapest bond to deliver given the 20 or so bonds that are available. That's what cheapest to deliver means. But you have to remember that in the contracts there, and just in the overall mechanisms or Treasury bond futures contracts, is that there's price adjustments for such things. So there'll be mechanisms and schedules and formulas on how to adjust for price differences. If a particular bond happens to be delivered and it's not that valuable, there'll be a price adjustment. But nevertheless, even though there are price adjustments that are allowed for, there's still some gamesmanship that can be had with the cheapest to delivery. These are options. So these are futures contracts that have the option of what to deliver. So that option does have value. But so there is some gamesmanship that can be done by the short trader in delivering certain types of bonds. And it's not a whole lot, but that's what they mean basically by cheapest to deliver and the delivery options. So, it's quite detailed. I would just skim that material at best. The other thing we want to recall is I developed a separate video that you should view before this video that has to do with duration and bonds. And if you recall from that video, is that when we want to figure out the percentage change of a bond price, and that's what that says, and that implies risk. When the bond price changes, if it's changing, it implies risk. That approximately equals, that's the squiggly equal sign here, to the duration of a bond, which is measured in years, called Macaulay duration, divided by the yield to maturity, times the change in basis points. So if interest rates go from 2.25% to 3%, that's a 75 basis point increase. So you'd have 75 here. And then you divide it by 100, so this whole thing would be 0.75 overall. Okay. And there's a negative sign in here because when interest rates go up, bond prices go down. So you need to have this negative sign in here. Now, the previous chapter is all about this duration and what this represents, the interpretation to it. And then we just adjust it by 1 plus the yield to maturity in decimal form. So if the yield to maturity is 6%, the bottom fraction here is 1.06. This whole term right here is called modified duration. And it is, as I said in the previous video, probably the most important concept in bonds that exists out there. And so it's important for bond management, bond portfolio management, and any strategies that you're trying to develop with respect to bonds. Now, this measures risk. Now, I haven't described what kind of risk, but I kind of implied it here. The type of risk that we're looking at in this formula is the risk that a bond price will change due to a change in interest rates in general in the market. Okay, so general change in interest rates, which will be given to you in various problems, along with the modified duration. You don't actually have to calculate this. These are specific formulas for this. And I will basically give you the modified duration that's needed for the contract, for the bond contracts, the futures contracts, and the modified duration for the actual bonds. So you're going to have a modified duration for bonds and a modified duration for the futures contracts, because underneath the futures contracts are actual bonds that can be delivered. So before we go further, I want to call to your attention. We're not in an abstract corner of the world of derivatives. This is a very commonplace concepts. I want to be very practical in the coverage here. So that's why I want to get right to the heart of practical applications without a lot of the fluff. Now, there's going to be some, because I have to develop the context in the environment in which we're in. But I want to get right down to, for example, well, given a situation, how many futures contracts do you need to hedge? How many futures contracts do you need for this speculative position? How many futures contracts do you want to have for spreads? Or if I give you a spread situation or a speculative situation, can you figure out the profit? Can you figure out the profit from stock index hedging? And that's the goal here. So before we go further, let's look at a Wall Street Journal article. It came out in November. See if I can get this. It's kind of hard. I had, because of the way the Wall Street Journal comes about, I have to slice it up. But let me zoom in for you, and let me resolve the focus here for you. Let me get the things in focus. And take a look at this. This is now or never for hedged bond ETFs. Hedged bond ETFs. Okay, so that's what the article is. It was November of 2018. And so let me go down here. It says these fixed income funds were designed for just this type of market environment. And so what environment are they talking about? Well, in the fourth quarter of 2018, the Fed made some comments. The central bank president made some comments. The chairman made comments that were very unsettling to the market, and so the stock market was gyrating at sometimes 1,000 points a day. It was going up or down, and the bond market was going crazy. And when that happens, obviously there's lots of risk. And when lots of risk happens, well, option prices start increasing in value. Remember, volatility goes up, the premiums go up. And then people start looking at options and more, closer looking at options and futures contracts to hedge their risks. So let's look at some of the stuff that's going on here. It says a number of fixed income exchange traded funds, okay, ETFs, include hedges designed to mitigate the effects of rising rates. Okay, many of these products launched a few years ago for this type of environment have been performing as their builders intended. Now, I'm not going to read the whole article. I'm only going to read various parts. It says interest rate hedging. To understand how interest rate hedging ETFs work, it helps first to understand the concept of duration and measurement based on the timing of interest payments and the return of principal for individual bonds. mean, that's one way to that's not very helpful in describing it. Expressed in years, so duration is in years. Duration can also be used to gauge sensitivity to interest rate fluctuations. Generally, a 1 percentage point move in rates up or down will shift the price of a bond or bond portfolio in the opposite direction, which is why I had that negative sign in the formula a few minutes ago, multiplied by the duration. So a rise in rates of 1 percentage point, in other words, I think they're referring to 1 percentage point, 100 basis points, would sink the price of a 5-year duration bond or bond portfolio 5%. So they're not using the word modified duration, but that's what they're talking about, modified duration. So if you have a modified duration of 5, measured in 5 years, that means if interest rates go up or down 100 basis points, then your portfolio or bond is going to go up or down 5%. That means a capital gain or loss of about 5%. Alternatively, an ETF could use a type of financial derivative known as interest rate swaps to achieve the same effect. That's the next chapter. When we spin out of this chapter, the next chapter is interest rate swaps. The actively managed iShares interest rate hedge corporate bond ETF does this by holding shares of $31 billion in iShares iBox dollar investment grade corporate bond ETF, better known as liquids, the LQDs, and by selling derivatives that entitle the ETF to floating payments in return for fixed payments. That's what a swap does. Okay, that's what the plain vanilla interest rate swaps that we're going to cover. Swaps fixed for floating rates. Now, let's go on a little bit further in the article. It says, while interest rate hedged fixed income ETFs simply seek to eliminate the risk of rising rates, WisdomTree, they produce a whole bunch of, they sell, they're like a large financial institution that sells a lot of ETFs and mutual funds. WisdomTree also has a huge shingle for products that attempt to actually goose returns for those looking to take more aggressive stance in a rising rate environment. With roughly $100 million collectively in negative duration high yield bond and negative duration U.S. aggregate bond, the WisdomTree products target -7 and -5 durations respectively. So wait a second now. How do you get minus durations, negative years, so to speak? Well, that's what happens when you take short positions in futures contracts. So if you go long a futures contract, you're going to have a duration that's positive measured in years. You take the short position, it's negative. But the point is, you can't get a negative duration without going, well, you have a really hard time coming up with a negative duration in using just bonds. You could go long bonds and go short bonds, and so if you take a bigger short position in the bonds, you'll get the negative duration. But many traders avoid shorting bonds like the plague, because remember, when you short a bond, you're responsible for the coupon income that's generated. So that means you constantly have to pay money out for the coupons. Just like when you short a stock, you're responsible for the dividends. Well, so what that means is futures contracts become way more more flexible and optimal way of hedging and getting negative durations than using actual bonds. Okay, so if we continue here, it says, so a rate rise of 1 percentage point would send the price up 7%. Such exposure would supercharge fund returns in a period of aggressive rate increases, but also leaves it more vulnerable to losses if interest rates stay the same or fall. Okay, so what it's telling you is, look, these things are souped up, geared up for interest rates that are rising, because many people think the Fed is going to start increasing aggressively interest rates. That's why the market's so volatile. Well, if interest rates aggressively increase. You want something with a negative duration, so that the negative and the negative sign, really what we're talking about here is this formula I had. If interest rates go up because the central bank is raising rates, you want to have a duration, a D that's negative, so that the negative and the negative sign flip over to a positive sign, that the percentage change in the bond price or the futures price is positive, so you make money. Okay, so let's jump right into Treasury bond futures contracts. What we want to do is pretty simple, I think. We want to take the fluctuations that occur in a futures contract position. All right, so this is what this is telling us is we're taking the modified duration of a futures contract, multiplying it by the contract value. You know how many bonds are in the contract, and then multiplying it by the number of contracts that we need. Okay, we want this, so this is the value. This is how much change we have when interest rates change in the futures contracts. How much is the futures contract changing? We want that to offset this whole term here, to be offset by the underlying position, bond position, that we're trying to hedge. And so this is the underlying position that we have, the value of that position. This is the modified duration of that position. And so this is a sensitivity overall in dollars, and the overall sensitivity of futures contracts in dollars. We want these two, when you subtract the two, to equal 0, which means your overall position, your natural position you have in the market, in the spot market, and then the futures market netted together has no risk. So we want no risk, no volatility. And if you rearrange this formula, you get another intuitive look at how this works. And here what I'm doing is I'm saying the value of a futures contract, I'm calling that F, consistent with the textbook, no little subscript 0, so don't confuse that with futures price. Just F meaning the size of the futures contract, or the value of it. And then the value of the bond portfolio that you're attempting to hedge, we're just going to call this B. So when you rearrange it, what we have is this formula, and this is the key formula that you need to determine the optimal number of futures contracts to hedge this position right here, up here. Okay? So how do you interpret this? Well, this part is relatively simple. It just means that if you have a really large position of bonds that you want to hedge, and you're hedging with a futures contract of a certain size, the higher that portfolio is, the more futures contracts you're going to need, just to take into account the difference between your the value of your bond portfolio and the value of the futures contracts up here. Okay, so that's intuitive. The other thing you need to take into consideration is the relative sensitivities, and there it is right here. This tells you the modified duration of your bond portfolio, and this is the relative to the modified duration of your futures contracts. So if we just said, look, if the modified duration of your bond portfolio is 3, and you're using a modified duration of a futures contract has a modified duration of 1, then that means, all else being equal, you need 3 times as many contracts, because this will boost this up 3 times, all else being equal. You need 3 times as many futures contracts to be able to absorb and offset the risk associated with your bond portfolio up here. So the formula is rather intuitive. So let's just use it now. And I have an example. The best way to do it is using an example. Suppose you're managing a $25 billion T-bond portfolio, and strongly expect interest rates to rise in the near future. Thus, you decide to use March T-bill futures to reduce your portfolio's sensitivity to interest rate changes. Your portfolio's modified duration without the hedge is 14. The T-bond futures are trading at 98.14, and that's a special type of notation that means, and you're not going to need to know this, I would give it to you in dollars, but it means 98 stands for 980, and then 14/30 of a $10 amount, because these prices increment. Every time you change this by one, it really changes it by $10. You see that? And so if it went to 99, I would be up $10. And so it would be 990. So that's where this $10 increments come in. And we're taking 14/32, so there's $9 increments. Don't ask me where this is convention. I don't know where it came from. It probably developed over decades and decades of bond trading. But that's just the way it is. So in other words, this is what you'll get. But I just wanted to show you that bond prices are not always disclosed in nice, neat, clean dollar amounts. So this bond is selling at a discount by about $16. Okay? Or this futures contract. So this is a futures contract, and that's the futures price. Okay? The underlying T-bill has a modified duration of 12. So now what we need to is simply fill in the blanks here, basically. The numbers are pretty much given to us. The modified duration of our bond portfolio is 14. The modified duration of the futures contract is 12. We have $25 million of a bond portfolio to hedge. And then the size of our contracts, F. Now this is somewhat tricky here in that there's a bunch of different ways to look at this. But each contract controls 100 bonds. Okay? So you could take the price, 984, 38, times 100, okay? And that would get you the number that you're looking for the value of your futures contract. So this is the futures price times the contract size. There's other ways of getting to this, but here's a simple way using the numbers I've just showed you. So when you do the calculation, we get minus 350 million divided by 1,181,256, and that equals minus 296 contracts. Okay? So the question that I ask here, and I didn't even ask it yet, should you go long or short, and how many contracts do you need? Well, the negative sign's telling you need to short 296 contracts. And so that's the answer to part A. And I'm around, I changed some of these notes, I edited them. Well, I'm around approximately page 9-ish on the notes. Okay, part B asks, now suppose interest rates rise 50 basis points and your bond portfolio drops to 23.25 million for a loss of 1.75. So remember, we started off with a $25 million portfolio. Now it's worth 23.25. Why? Because interest rates rose, and when you own a portfolio of bonds and interest rates rise, you expect the value of the bond portfolio to drop. Okay, what is the gain on the value of the futures contracts and the net overall profit or loss on both the futures position and the bond futures or the bond portfolio? Okay, so let's look at this now. So let me write it out and attempt to explain it. So we're going to use that 296, the number of contracts, and then what we're going to do is let me put it in decimal form, and just another way of rewriting the same idea. Give me a minute to explain this. Okay, so here's the number of optimal futures contracts that we just determined to be. And so here's the bond price. Here is the price of the bond in decimal form. So you recall it was $984.38, but when you multiply it by the bond futures contract size, the contract size at par value, given it's 100 bonds, and 100 bonds times 1,000 is 100,000. So that's one way to write out the contract size right here. And then here's the price of those bonds relative to the contract size. So if you multiply that all out, the value of the bond futures contract is $98,438 when you multiply these out. That's nothing but the $984.38 times 100 bonds that you need. It's just, I don't care how you write it out in a quiz or a test, but I'm getting to the same answer. Now, the question is, what the heck is this number here? Where did I get the 92? Which means the bond, these futures prices are 925.3. So where did I get that from? Well, if you look at the duration of those futures contracts, they were 12. And then there was a half a basis point change, 50 basis point change. Okay, that's what the 50 basis, it's a half a percentage point. Okay, that equals a loss of 6% on the bonds. So when you have a duration of 12 and interest rates go up, as the problem says, 50 basis points, that means your portfolio is going to lose 6%. So 1 minus 0.06 means you're left with 94% of the original value. The original price in decimal form, which turns out to be 0.9253. So there you have the capital loss here, but it's offset with the negative sign, okay, because you're short the position. And so what you have here is you have a gain of $1,748 and change. That basically offsets pretty closely the $1,750 loss you have on your bond portfolio. So this is your bond portfolio. This is your futures contract gain. So you lost this in your bond portfolio. You gained this with your futures contract, which, look at that. That's pretty good hedging. So you're pretty happy with that. And so you lost, overall, you lost what? $1,232. Which is not too bad given the size of these positions. Now what we want to do is let's go into stock index futures contracts. Let's jump right into this with an example. The example is a spread strategy I'm going to show you. And sometimes I like to refer to spread strategies as, it's going to sound funny, but it's kind of like speculating with a hedge. A speculative hedge. And if you recall what a spread strategy is basically you are looking at the spread between two prices and trying to take advantage of whether or not that spread will increase in value or decrease in value. Because the prices between various assets can go closer together and pull apart over time. And so if you can go long one instrument and short another, and do it in such a position to be able to take advantage of the prices narrowing or expanding, you can make a profit. Well, kind of you're reducing your overall risk, because the context that you normally look at in these is you go long, say, one asset, or you short another. Well, if you go long or you do a short, you're subject to a ton of risk. But when you go long and short two contracts or two spots, then you're kind of reducing your risk a bit. And your goal here is to make a profit either through the convergence of two prices or the divergence of prices. So let's go right to an example to make more sense of this. So suppose you're speculating, you're a speculative stock index trader with a $10 million client base. So you manage $10 million of your client's money. Your objective, consistent with your advertising strategy, is to take risk and maximize the return on your client's accounts. Your proprietary trading model, which means it's a secret, your secret trading model signals an upturn in the NASDAQ. In other words, small and high-tech stocks are expected to rally, but not the Dow. So you expect the Dow not to rally. You interpret this signal as a perfect time to employ a spread, since the model you rely on is occasionally wrong. So if you're occasionally wrong, and if you just go long the NASDAQ by itself, you're taking a ton of risk because the NASDAQ can fall. Your goal here is to take advantage of the spread, the difference between the NASDAQ and the Dow, by going long one and short the other. Thus, in this example, you go long the NASDAQ, and the multiplier of these, and so this is with futures contracts now, we're going to use futures. The multiplier for the NASDAQ is 100, and for the Dow, the multiplier is 100. And that makes sense because the NASDAQ is much smaller. The index value of the NASDAQ is much lower than the Dow. And so those contract sizes are to try to somehow normalize or not equalize, but at least bring them closer together in terms of the size of one contract. So again, we're going to go long that NASDAQ because we think the NASDAQ is going to go up. But if we take just the long position, we're taking a ton of risk. So what we also do is we short the Dow because we think the Dow is either going to stay flat or possibly even drop. Okay, so now let's look at the NASDAQ right now. The NASDAQ is currently, the NASDAQ futures price is 5,000. That's the futures price. And let's see, the Dow is 18,158. Okay? You decide to balance the strategy so that you have $5 million long and $5 million short. So you got a position that's 5 million long and 5 million short. So it's basically telling you what you need to do here. So the number of NASDAQ, the number of contracts we need to go long is going to be, well, we need $5 million according to what I just said, position. And the contract size for the NASDAQ is 5,000, and the index, or the futures price is 5,000. The contract size is 100, and so we're going to need 10 long contracts. Now, for the Dow, the number of contracts we need for the Dow is again going to be $5 million position because we want equal positions. We have a Dow worth 18,158. The contract size is 10. That implies 28 short contracts. And there may be rounding involved, so approximately equal signs works out. You round to the nearest contract because if you, obviously you can't buy fractional units of a contract, but if you overhedge slightly, then that's exactly what you're doing. You're overhedging, or you could be underhedging, depending on how you round. Just keep that in mind, but it's pretty small here. So we're just going around the 28. So this answers part A. And part A says, how many contracts do you need for the Dow to execute this contract? And how many do you need for the NASDAQ? So that's what part A is all about. Now let's look at B, part B. Part B says, if at the futures maturity, okay, when the contracts mature, the NASDAQ stands at 5,700 and the Dow at 18,200, what is the profit from each position and overall? So let's look at the long here. Okay, we're long the NASDAQ. And so it's now 5,700. When we put on the contract, it was 5,000. That's exactly what we thought it would do. We thought there'd be a gain. Times the 10 contracts times the contract size. And now we have a profit of $700,000, okay, for the NASDAQ. And we were short the Dow, And so minus 18,200, right, which is where we ended up now. This is where we ended up. And when we put the contracts on, it was 18,158 times the number of contracts times the multiplier. And we lose 11,640. So overall, the net effect of this position was we made 688,240 on this position. You know, things pretty much went like we thought they would. We thought that the NASDAQ would go up, the Dow would stay relatively unchanged or even drop a little bit, and so we made out, and so we have a profit of 688. So you got to ask yourself, you know, what did I intend to happen? And if what I intend to happen actually happened, I should make a good profit. And if something comes out negative or small, you got to question, why isn't things turning out the way they ought to be? But they are turning out the way they ought to. Now let's look at what happens. So basically, by the way, basically what we're doing in this problem is we are hoping, or we are expecting, right? We are expecting the spread to narrow between these, okay? Oops. Yeah, we're hoping that because we expect this lower number to go up in value, right here, the NASDAQ to go up, and this to stay relatively the same or go down, then that means the spread between these prices we were hoping to stay the same or narrow. Okay, we would have made the most if it would have narrowed. Now let's see what happens if things go against what we're doing here, our strategy. And here we're saying, what happens if the NASDAQ goes to 4,200 and the Dow goes to 19,000. Ooh, that means the spread narrowed, or I'm sorry, it widened. It widened. You can read that. It widened because the Dow went up a lot, the NASDAQ came down, so that difference between those two numbers narrowed or widened, and so we expect to lose some money. So NASDAQ, we went 4,200 minus the 5,000, so there's the 4,200 there. It's where we started, times 10 contracts, times the contract size, and we lost 800,000. Well, you know, we expected the NASDAQ to go up. It didn't, so we lost 800,000. Now with the Dow, it's now 19,000. It was 18,158, so there's the 19. Times 28 times 10, and that equals minus 235,760. Okay, we expected the Dow to stay flat or to drop. It actually went up. And so both positions, this is the worst part of putting on a spread. So spreads are designed to try to narrow your risks, but there's one situation to reduce your risks, but there's one situation where it can actually amplify your risks, is as if each instrument goes in the opposite direction of what you thought would happen. And that's exactly what's happening here. We thought the Dow would go up, it went down, or the NASDAQ would go up, it went down. We thought the Dow would go down or stay the same, and it went up. Ouch, ouch. And the double ouch is a 1,035,760. Okay, and so that's what happens with speculative hedging. You know, you think you have a hedge, and in most situations, you'll find that you've either eliminated the risk, or you have potential gains. But there's one situation where they both go against you and you lose. Okay, so now let's move on to hedging with stock, pure hedging. Say, you know, not speculative hedging, not spreads, but hedging with stock index futures. Okay, the formula for hedging with stock index futures is simple, and it's very consistent. Looks very similar to what we just covered with bonds. There's a minus sign in front here now. So the optimal number of futures contracts. Put a minus sign here. We're going to have the beta of your stock portfolio that you own, position that you're trying to hedge, divided by the beta of the futures contract. So the beta of the futures contract is typically the beta of the underlying to the futures. So if you have a futures on the Dow, you look at the beta of the Dow as the measure. And we multiply this by the size of your stock portfolio divided by the size of a futures contract. And so as you can see, you got to adjust for the difference in the size of your portfolio relative to the size of the futures contract. That's intuitive. You need to adjust for the amount of volatility that's in your portfolio. So beta, recall, measures how sensitive your stock portfolio is to a change in the market conditions, in the stock market conditions. So if this number is really high, you're going to need more futures contracts to absorb that extra volatility and risk. And then obviously, recall, you're going to need a negative position. So if you're long in the spot market, SPOT, then you have to take a short with the NASDAQ so they offset, or a short with the futures contracts so that they offset. Okay, so that's very intuitive, very consistent with what we just saw. And it also kind of shows you that, beta, what beta is to the stock market, modified duration is to the bond market, because all we did was we switched out these modified durations here and put in betas, and instead of the value of the bond portfolio here, we put in the stock portfolio. Okay, so now let's go right into an example. Suppose you manage a $20 million mutual fund with several hundred stocks. The fund is highly correlated with the S&P, but is more volatile, with a beta of 1.25. So your beta of your stock portfolio is 1.25. And what that means is if the stock market goes up 10%, then on average your portfolio is going to go up by 12.5%. It's going to go up by a factor of 20.25 in addition. Okay? If the market goes down 10%, then you're going to lose 12.5. So you're 25% more volatile than the market is what a beta of 1.25 is. Okay? You feel that the market, you feel that the market where the S&P 500 is currently at 2,200 is about to decrease dramatically between now and May. Rather than go through all the time and expense and trouble of unwinding your entire portfolio, you decide to enter into a futures contract to sell the S&P 500 index at May's futures price of 22.20. So now, look, the context of the problem says, and this is really common, you have this $20 million bond portfolio with 700 stocks. If you suddenly think the market is going to drop, a couple of things. One, you may not be allowed to sell your entire portfolio and put it in cash so that you can ride out the drop in the stock market. The bylaws and your prospectus may preclude you from doing that because investors expect you to take a long position in stocks the whole time, so you may not be able to do that. And the other thing is, even if you could, do you really want to unwind and sell all the stocks in your portfolio only to buy them back in the future, which entails a lot of transactions costs? So what we're looking at here is that a much easier way to handle the problem is overlay a futures position on it. So in other words, keep your portfolio as is, your existing portfolio, go in the futures market, put on your hedge, and then that's what we call an overlay. And so it's the overlay plus your underlying spot position is going to be your net effect. And what you're trying to do is, when you're hedging, remember, is not necessarily make a profit, although that is nice. It's trying to reduce risk. Okay, so now the first question is, before we go further, the contract size is 250 for the S&P. And the first question is, how many futures contracts will you need? We will need an F star equals the minus 1.25 with the beta of our stock portfolio. The S&P has a beta of 1 by definition because it's the market. It represents the market. So look, right away you're going to need 25% more futures contracts to absorb that extra risk. Then you have a $20 million portfolio to hedge, and the futures contracts, including the size adjuster here, is this product right there. So you're going to need minus 45 contracts. The negative sign is telling you short, go short, which makes sense. You should know that before you even get to the answer, that you need to short the position. Okay, you shouldn't be scratching your head and you know, if you forget a sign and it comes out positive, oh, got to go long. It should be intuitive what you need to do in terms of going long or short. Okay, so part B, let me get some space here because there's a little bit of writing to be done. It says, now, if the S&P 500 decreases to 2,000 in May, what will be your profit? And what will be your profit on your portfolio, your underlying portfolio, the futures contracts, and the entire strategy? In other words, your overlay plus the spot position. Are your results consistent with a portfolio with a zero beta? Oh, zero beta. Well, kind of that's you know, basically what we're trying to do here in this formula is if we are optimizing the hedge, and we truly want to hedge everything in the right proportion, when we get done, we should have a zero beta for our hedged position plus the spot, which means we're not changing and we're not making any profit or losing any profit. We're not taking on any risk. So let's do the calculations. Let's figure out what the profits are here. And then if the profits are exactly zero, then that means we have a zero beta. If they're positive or negative, that means we haven't quite exactly come up with a perfect zero beta hedge. But we should come close. We should come close. And sometimes the difference is due to just rounding the number of contracts. So the problem comes out where we round the number of futures contracts. That in and of itself could be the source of our non-zero beta from these strategies. Okay, so now let's look at our portfolio. This is a little tricky, but I think it's pretty cool. So we ended up with a $2,000 value of the index. The S&P ended up at 2,000. When we started the position, it was 2,200. So we lost 10% basically, or close to 10%. 0909, right? On our portfolio, well, that's what I should be careful. This is what the index changed by, okay? But now remember that we have a beta of 1.25. So here is our percentage change, 9.09. Now this is how the market changed, right? But remember, our portfolio has a beta of 1.25, so our change in our value of our portfolio fell 11.3625%. Okay, it gets magnified by that. So what happened is our portfolio went from 20 million where we started to basically coming up to about 88%, 87% of its initial value, which is what's in the brackets here, and that comes out to be 17,727,500. Okay, so we have a loss, 2,272,500. Okay, that's our loss on our portfolio of stocks. Now, before we go further, we should know that if we put this futures contract position on right, we should be offsetting most of this loss with the gain in the futures contract. So the gain in the futures contract is this. Okay, the 2220 minus the 2000, okay, times the 250 contract size times the 45 contracts means we gain 2,475,000 $2,475,000, which is offsetting all of this. In fact, we're gaining a little bit, so we don't have a perfect zero hedge on the whole combined strategy, but it's pretty close. And things just turned out to work in our favor by, it looks like a couple $100,000 here in the difference. Okay. Now, let's move on to target modified duration and target beta. Yeah, so targeting modified duration and beta. The example that we saw, by the way, in the article talked about targeting modified duration of -7 and -5 in a portfolio. So you could buy this exchange traded fund, and when you buy the exchange traded fund, it has a negative modified duration of 7. So you can use that to offset your other positions in the spot market with your in your bond portfolio. So let's actually get right down to it. You're going to find this also rather an intuitive discussion and only a simple adjustment to what we've already know and the formulas that we've already been applying. So let's get right to it here. We're looking for an optimal number of futures contracts given that we want to have a target duration or a target beta. Let's look at the duration first. Okay, so here's the formula, the optimal number of futures contracts with a target in mind. Now, it's the target, the modified duration target that we're looking for, and that's measured in years, that's the sensitivity to interest rates, minus the modified duration of our bond portfolio, divided by the modified duration of the futures contracts, again adjusted for the relative sizes between your portfolio and the futures contract. Now, what we've been used to doing so far is this has been 0 all along in our previous formula. So the previous formula was this. So this was the previous formula. We implicitly had a 0 here because what we were trying to do is come up with we had a target of a 0 beta in there. We wanted to make sure, or 0 modified duration. We didn't want any gain or loss associated with a change in interest rates. We wanted to completely eliminate interest rate risk. So we implicitly had a 0. Well, when you put a 0 here, it just kind of goes away, right? Now what we're doing is we're saying, look, we want this to be a number. We have a specific target other than 0 in mind. And now this is the formula that we have. So if we have a target where we want this number to be high, then we're going to need more futures contracts. If it's going to be low, we're going to, and that's going to entail a long position. If this turns out to be negative, the upper part of here, the numerator here, if that's high, then we're going to have to go long futures contracts. Okay, so let's actually, well, before we, I was going to get to an example, but one more thing before we get to the example. Let me be consistent with the notes. So this is intuitive. Let's look at the number of futures contracts for stocks. And the formula is going to be this. The beta, a target beta that we're looking for, the beta of our actual stock portfolio now, divided by the beta of the futures contract, okay, multiplied by, you guessed it, the value of your stock portfolio relative to the futures contract size. Now, we have been assuming before that this is 0. And when that's 0, it kind of washes out, and this is the formula we've been looking at previously in this video. So now you have a target, and if the target is high relative, so think about it. If the beta of your of your target is high, really high, relative to where you are right now, that means this is going to be positive. You need to not only have you're going to have a long position in your underlying stocks, but you're going to have to even take a bigger long position in your futures contracts to get that high target. If that target is low, like 0, you're going to have to short, which means this is going to be negative because of the sign here. So it is rather intuitive. So let's go right to a problem here with actually I'm going to do it in stocks. Because once you see it in stocks, you can do it with bonds quite easily. So the problem is the example. It says assume the same information above that we were working with a few minutes ago. You manage a $20 million stock portfolio. However, you want to increase the beta of your portfolio to 2 using futures contracts. Remember, it was 1.25. You want to bring it up to 2. The reason for the increase in beta is that you expect a significant rally in the S&P 500 and want to profit from the extra exposure. So you want to spike your portfolio. You got this portfolio as a beta of 1.25. Man, you expect the market to go up. How do you get that? How do you take advantage of that? Well, you're not getting any extra money in, so to speak. But how can you spike your returns? You're not getting money from your investors at this moment. That's kind of one way to do it, at least in dollar amounts. But you're still not going to pick up a percentage basis doing that. So what you do in this case is we're going to spike our portfolio. We're going to go long futures contracts on top of the long spot position that we have. And by doing that, if we're right, we're going to have a really nice positive gain. If we're wrong, then we're going to have to explain ourselves to the shareholders of this fund because we would have lost money, at least relative to the market. So here we have the optimal number of contracts, futures contracts. I'll write it out, the formula. And let's drop the numbers in. We want a target of 2. We're at 1.25. So it's positive, meaning we need to go long futures contracts. We're using the S&P 500 as the contracts to hedge against, and they have a beta of 1 by definition. We have a $20 million stock portfolio. The futures contract size is the futures price times the multiplier, $250. We get done with this, we get 0.75 times 36 and change, about 27 contracts long. Okay, so that was the question. Well, there was 2 questions. How many contracts do you need? 27. And do we go long or short? We need to go long. And again, that's very intuitive. If you're taking on additional risk, you want a higher target, then you're going to have to go long. Okay, now let's do another example. And this goes right to hits right at this Wall Street Journal article. This is an example. So let's look at it. So suppose you're a portfolio manager for an inverse, now get this, an inverse 3x S&P 500 ETF. Okay? Now what the heck does that mean? Inverse 3x S&P 500 ETF. Okay, so first off, it's the foundation of the whole analysis is based on the S&P 500 exchange traded fund. It's based on the index of the S&P. Okay? The word inverse tells you that you want this exchange traded fund to move the opposite of what the S&P is doing. That's what the inverse means. Basically means, you want to go, when the market goes up, you're going to lose money, and if the market goes down, you're going to make money. Okay? Now, that's exactly what was being discussed here in the Wall Street Journal article where they talked about negative duration bond portfolios. Negative duration. Well, that's what we're doing here. We're taking negative betas, basically. That's what the inverse is saying. Now, the 3x means, this is another twist on it. Okay, so we want a negative position, a short position in the S&P, which is what it's saying so far. But we also want things to have a beta of 3 times. So we want to spike it even more. We want when the S&P goes down, let me draw it to scale here as best I can. If the S&P goes down by this amount, this inverse fund will go up 3 times that in the opposite direction. Okay, so if this is 1% down, then this will be plus 3% up. Okay, so now how many contracts do we need? Number of contracts, or which I've been using as NF. Okay, well, that's positive beta for the target minus beta of our stocks, beta of the futures, times S over F. Okay, and we want a target of inverse 3. That's what that's saying. We want an inverse 3 target. So it's minus 3. Right? Now, I'm making the assumption here that we have a portfolio of stocks where we're shorting the actual portfolio. So it's the negative, and a negative means this turns into a positive. And I'd have to tell you, be more clear about this in the example that I'm doing here, is that if I had a long position in the stocks, then this would be a negative sign. But again, assume that we have a short position in our underlying portfolio. Okay, so let me read the rest of the example before I finish this part. Okay, so now we assume that the value of the portfolio is $10 million. We have a $10 million portfolio in the S&P, and the S&P futures contract is 2,300. How would you go about capturing an inverse 3x return using stock index futures? Okay, so you're going to figure out the number of contracts. That's the first thing you need to do. But again, we have a target of minus 3. I'm assuming, and if it was on a quiz or something, I'd have to tell you what our underlying portfolio is. Is it long or short? I'm assuming it's short, so the negative and negative means it's positive 1. The futures contracts are a positive 1 in beta. The portfolio is $10 million relative to the contract size, 2,300 times 2,500, or 250. That means we need to go minus 2 contracts, right? And then once we adjust for the size of the portfolio differences, the contracts relative to the portfolio, we need to short about 35 contracts. 35 contracts short. Okay. So the point is, if we're already short beta of 1, and we want a short a beta of 3, then we need to take 2 more contracts, and we need to go short those contracts. So we go short 2 futures contracts plus the short futures position we have in the spot. That adds up to 3, and it all kind of works out. Now, before we go, and this is the end of chapter 10 notes, one caveat on optimized hedging, as we've been doing throughout this video, is, as I say in the notes, don't even think for 1 second that the strategies presented here or any other optimized hedge are static, meaning you just throw the hedge on and you walk away from them and they stay optimized. They don't stay optimized. You got to really keep up on it, because betas change, covariances change, spreads change, durations change. Look, duration changes just by the fact that time goes on and your bond starts to shrink in maturity. Well, that in and of itself is going to cause a change. Even if nothing else changes, your duration, your modified duration will change just with time. Sensitivities will change. Basis risk will change. All of these things play a role in your ability to hedge and to optimize the hedge. So the point is, you optimize initially, you keep your eye on the position to make sure it's approximately still optimized. And so, you're not going to optimize it down to the infinitesimal little, fractions of a futures contract. When it gets out of range and it gets a little sloppy, you're going to try to offset that. And so you re-optimize, you recalculate, and you re-optimize and change the number of futures contracts so that you maintain the hedge. And that's the point. You got to monitor this closely to keep these optimized hedges at their optimal.